Good afternoon, and thank you for joining today's roundtable Examining Sectors with Disruption, presented by The Deal and EY. I'm Rhonda Schaffler with The Deal. During our discussion, you're welcome to submit your questions for the panel using the posting feature to the right of your browser. If time allows, our panel will address them later in the hour. Today, we are looking at the issue of how disruptive technology is driving fundamental changes to traditional business models. Some of the topics we'll cover include how technology is disrupting and transforming numerous sectors like healthcare and finance and technology. We'll also look at how disruptors are changing companies' strategies and operations and how investors should value companies that are transforming. Joining me in this discussion, Tyler Newton, a partner at Catalyst Investors, Nadine Merchandani, America's transaction leader in the financial services office at EY, and Jim Demetrius, CEO of iLock. Welcome. So good to have you all here. We're going to have a great discussion.
Our pleasure.
Nadine, let me start with you. How do you think about disruption? How do you approach the idea?
I think fundamentally technology is really what has been a large part of the groundswell around disruption, and I think about it thematically in three different ways. So first, I think technology has allowed us to disrupt the supply chain and disintermediate the marketplace, essentially, and has also shifted where value is driven in that supply chain. So I think that's one big piece of the equation. The second, I think, and fundamental, is the fact that technology has allowed this great asset in data. Right, and that data asset has allowed different people to do different things, I think, differentially with their customers, with respect to new products, new markets, new innovation. And so it's intelligence, essentially, that is allowing us to drive the market. So that's part of the disruption equation. And I think last and perhaps most significantly, when we think about what's happening with sectors, is the fact that barriers to entry that have been high have been eliminated and or reduced. And so now we have an ecosystem that is no longer sort of clearly defined, and it's in fact inviting new entrants into the marketplace. So those are sort of, the way I think about it, three thematic drivers, and technology has been sort of the voice around all of those.
So Jim, let me go over to you because you are a disruptor and technology is working in your favor. So how did barriers to entry change for you and your company that helped enable you to move forward with products?
Well, I think following from Nadine's opening remarks, I think one thing we're seeing in technology that segues to your question is that the old business models are challenged and it's a death knell. So what's really happening is there's a sense of awareness and responsibility that you need to be on top of what's happening from a technology point of view in your sector and your competitive sector. So for us, we are a disruptor. We think we're adding a positive security, identity management capability to many of the things that people are adopting as new technologies. We saw our friends at Apple disrupt the whole world of passwords and introduce a biometric on a smartphone. And that was eye-opening, no pun intended, but also paved the way for market awareness and for us to enter these new markets as well.
And Tyler, your thoughts on the topic?
Yeah, I mean, when I think of new technology, right, things are either producing a new, something new, like I say a Facebook or something like that didn't exist before, or you're helping people become more productive, right, which is what software does, or you're helping eliminate friction in the market, right? And oftentimes, friction is other people's profit margin. And now that technology has come and broken down some of that friction in the marketplace, that's what really disrupts other markets. Either you have something replacing it, or you're eating into their profit margin in a big way.
Nadine, you mentioned the supply chain equation, which tells us that disruption's been going on perhaps before the average person sees it, before the consumer realizes that things have been disrupted. So it's really happening first at a high level, and then it filters down to where we have that aha moment that things have really changed.
Right. So I think we all as consumers see it sort of in our customer interfaces, or frankly access to services, products, et cetera. But there's a lot that goes behind that, and we talk a little bit about where does the spend and some of the legacy incumbents, where is it going? A lot of it has been sort of focused necessarily on the front office around that customer experience, because our expectations have changed about what that looks like. And in financial services, we talk about that. There was an article this weekend on the topic. But behind all of that, you can't get to good customer experience answers unless you've fixed sort of the middle and the back office, as we like to call it in financial services. And so we're going to see a shift in more, I think, spend to solve for that, because we've got legacy technology, we've got systems that don't necessarily talk to each other, that were built for bespoke reasons. And a lot of that is what's creating the friction around sort of seamless experience and or seamless product, but it's also inhibiting the capture of that data asset and making sure that the right things are connecting and talking to each other so that we can better serve the product to the customer and better serve the right product to the right customer.
So financial services is an area where you are looking at as well, Jim, in terms of disrupting the way things have been done for years, really.
Yeah, clearly. Disrupting, but also enhancing, I would put it that way. So the business models are shifting in financial services, whether it be Dodd-Frank or other high capital requirements. The bank's access to revenue streams is changing, and one of the responses is to look at their cost structure. And technology is a clear way in which they can provide services and also take cost out. And those costs are either people costs or real estate costs. So technology becomes key. We like to think that the role we play in authentication provides a level of security so the bank is assured with their protection of customer data, as well as authenticating the actual customer versus somebody impersonating a customer.
How big is the potential in terms of financial services disruption, would you say, Tyler?
Yeah, I mean, we're seeing it all, every day, and you've seen a lot of areas that were once lucrative places to work become much less profitable. You've seen the automation of equity trading, the automation of options trading. You've seen it in ETFs eating away at mutual fund margins. And the automated high frequency trading, right, which is eating into a lot of the old ways of doing business. So you're seeing a lot of it just in the products itself. Then you also see it in the back office, as Nadine mentioned, how if you really think about a lot of the employment has been basically flat in the financial services industry, but it's been shifting from back office employment to front office employment, and a lot of these jobs that used to make up the backbone of financial services are being disrupted away, everything from tellers to file clerks to administrative assistants, everything. So it's really changing the nature of the employment in the sector and making it more of a high-end employment sector and not more of a broad-based middle-class employer.
And often it's adding productivity to the equation. So yeah. I think people are more efficient, and I think they're able to access online transactions in the way you described, which actually is a big plus overall for their profit picture as well.
And that goes back to that sort of supply chain and where value is perceived. So the things that maybe are routine, like sort of transactions, I probably don't need to speak to 3 people to do that. Right. But where I do want value is perhaps when I'm getting financial advice. And we can talk about that spectrum changes depending on how complex that financial advice is. And so it's allowing, I think, companies to put their resources in the places where the market perceives value. And that's an evolution. I think we're in a shift to how that is going to sort of actually transpire. I don't think we're there yet.
So what's the next step in the evolution?
It's a very good question. So what I think is really interesting is that we call it industry mashups. So to get to better financial services answers, maybe we have to look outside of the financial services industry, or we're going to see sort of tie-ups amongst non-traditional financial services incumbents, sort of take data and models from others. So we talk a little bit, and frankly a lot, about the auto industry and the insurance industry and the technology industry. So that's a great example of an industry mashup. And are we going to better serve the customer by giving them a more bespoke product, potentially, at a better price? Yes. But we also now need to take in different data, right? So the data that might come from all the sensors on cars. And so we have to sort of make sure that the auto manufacturers and the auto industry is contributing to that ability for us to better underwrite in the insurance sector. And so this is no longer a monoline ecosystem. And this is where the relationships amongst non-traditional business partners are going to become that much more important.
Yeah, I was going to say also, I think the advent of the advent of the robo-advisor is going to be huge, right? Where people now have a more efficient way to get the kind of sophisticated financial advice that they may have gotten from a human, right? When now they don't, someone who's young or doesn't have a lot of financial experience doesn't know exactly how to invest, and they have this way to make it easy for them. The combination of that ETFs and then also automating a lot of the hedge fund strategies continues to, I think, provide more value to the customers, but also break down a lot of that market inefficiency that's been the gravy train for a lot of people in finance.
People have talked a lot about robo-advisors, and I think what it's done is actually it's increased the market size and the addressable market to be served by that industry, by the asset management industry, because it's allowed us and participants to provide a product in an efficient and profitable way to probably a segment that it wasn't attracting before. So it's attracting new assets to the industry, and those assets need to be served in a different way. And so I think it's really about growing the addressable market. So disruption doesn't always mean that you take market away. It can actually be about increasing the market size.
Yeah, but I think it's also that technology often bubbles from the bottom up,
right.
And you'll find that I think it's going to be appropriate as a product for a lot of people who have a lot of money, actually a decent amount of assets, versus just young kids starting out.
Yeah, and just to tack on at the end there, it's about leverage as well, which goes to the cost structure. In other words, the financial institution can leverage the genius of the advisor through the technology to more people. He's got a lot of dead space in between appointments, et cetera. This is a way in which you can leverage that technology.
Yeah. I wanted to address the cost issue because with disruption and to disrupt, you need to invest in technology. It's a process. And I'm wondering how the cost equation balances out. You still have to make an investment up front, right? So when you think about how companies are being disrupted, how does that change the way you think about valuing them?
Yeah, I actually would disagree with the question a little bit. You no longer need to make the investment up front, right? Everything's being transformed to cloud-based, service-based.
So you just jump on.
15 years ago, you had to buy a bunch of servers, you had a server room, and you had to buy the software. No longer. Right now, I mean, maybe at big banks they still do it that way, but for most smaller companies, you just pay by the month.
How about retraining employees to move into different roles?
That's a reality. I think you're talking about sort of shifting talent to different places, and you're absolutely right. That includes retraining. We hear a lot about robotics and the topic of robotics, and it's not necessarily robots, but it's about sort of taking technology, software, and having it automate certain things. And certainly that might result in changes in your workforce, but we need to have, and I think you're absolutely right, we need to have sort of I think, proactive ways to, one, prepare the workforce for the new economy, and two, to retrain that workforce to places where, sort of human intelligence continues to drive the difference.
Well, I think, Tyler's right about technology's taken a lot of the costs out of the equation. However, for most folks that we deal with, it's still ROI, return on investment. Mm-hmm. And it's interesting, the different ways to measure. Obviously, there's total cost of ownership in terms of swapping one technology for another technology, and it does involve some CapEx in that instance. But you've got other benefits and costs that need to be considered. So you talked about training, that's key, but customer retention is a great asset. Mm-hmm. So when you make these swaps, you have to factor in the cost of what the experience does to your customers' relationship with the institution, exactly. So we still look at ROI in many cases, and we know our customers are, although as Tyler points out, using the cloud is certainly much easier than where things were a short while ago.
How does disruption, Nadine, over to you with this, vary by industry? Is it always the same kind of 3 points that you outlined in the beginning, or does every industry perhaps present some unique challenges when a disruptor comes in?
So I think no industry is immune from disruption, but I do think there are certainly unique aspects to it. In the space that I spend my time, which is financial services, we've got a regulated industry, and that's certainly going to be a voice in the process of disruption. In fact, what it might do is create sort of opportunities, right? Sort of arbitrage opportunities amongst the regulated and unregulated. So I think there are some unique factors amongst industries, but the themes I think I outlined are still the same themes across the board. I think we're just going to see the pace of evolution change. And part of that is the industry local? Is it global? Is it human capital oriented? Is it manufacturing oriented and hard asset oriented? I think those are all factors that will affect pace. But I think every industry is going to, maybe not be disrupted, but every industry is going to evolve and innovate. Mm-hmm. Right?
Yeah, I think a big factor here is corporate culture, and industries have their own culture. I mean, we watched the automotive industry just about go bankrupt. and now there's a new culture that's working through automotive. So the ability for automotive today to adopt technology, it's being pushed by the Silicon Valley guys, so driverless cars. And now you're seeing an openness that wasn't there before. So I think while there's unique challenges, culture is a big thing. There's opportunity in healthcare. There's opportunity in education. These are slow-moving verticals in terms of adopting technology. Banking should be at the top because they've got the budget and the people to adopt technology, but there's a corporate culture in banking that slows things down at the end of the day. So it's a big challenge for introducing new technology is just breaking through the cultural barriers.
Although I almost feel like it's been fast in financial services, that we've seen a lot of change in the last 5-10 years, especially.
We have, and I think part of it is there's been no choice but to change, right?
True.
So there's been a lot of market sort of effects around that. We've been in a low interest rate environment. And so I think there was an impetus to change operating models. And I think what we've layered onto that is perhaps an urgency to create customer and change customer models.
Yeah, I actually think finance has been, in banking, has been one of the earliest adopters of technology. It's just such a complicated industry that they're constantly having to invest in new things. But I mean, even back in the 80s, I think, finance was one of the most computerized of the industries that there were. And tech itself, obviously, is one that constantly disrupts itself, right? And then media, right? And the other one, all these New York-based industries that have been really early adopters of technology have changed a lot. And now you're seeing it kind of bleed into a lot of these older line industries. Like education or healthcare, these regulated industries that have had good big barriers to entry, transportation, and energy as well.
Jim, since you work with a lot of different industries as customers, which one has kind of surprised you the way that they're moving forward in a disruptive pattern?
Well, I guess I would say automotive. Really surprised with the level of interest and the aggressive approach they're taking. Now, it's interesting that we talk about the Internet of Things, the Internet of Everything, and the automobile is a big component of your lifestyle. It's where you work, it's where you live, and what you drive, basically. And the automotive world is looking to monetize your experience and to create a customer loyalty with technology, and I think it's very impressive what we see in that sector.
How do you consider investments in certain companies and sectors, or when you watch a landscape, whether it's M&A or any kind of financial intricacy that will go on, when an industry is in the middle of disrupting, it's harder, I would think, to value what you're betting on in the future?
Yeah, I mean, adoption of technology can follow a relatively predictable pattern, actually. And to get wonky, it's the S curve, something y'all learn about in business school or whatever. And it's the hard part is getting the timing right. Mm-hmm. You can be really early, right? Internet of Things is an example of something that we've been tracking since the early 2000s, kind of thinking it's now it's time for, it used to be called machine-to-machine communications, and then now it's Internet of Things or Internet of Everything. And it still hasn't even really taken off that much, despite all the hype that's been in it. And so a lot of it is just trying to avoid being too early, because you can find that what you think is right around the corner could be still 10, 15 years. But then once it hits that tipping point, it's only 6 years later, everybody has it. Right?
What's been the delay?
It all builds on itself, right? So a lot of it was you needed the cheap enough hardware for it, and then you needed the processing power to get cheap enough, and then you needed the connectivity, right? And actually the connectivity has probably held a lot of it back, because if you have remote assets, you're not going to hook it up to fiber optics, right? So they needed the cheaper wireless connectivity, and cellular hasn't been cheap enough. You don't have Wi-Fi everywhere. So I think that's a little bit what's been holding it back. I do tend to think its time is coming, because I think a lot of those problems are being solved. But we thought that 10 years ago, and thankfully kind of waited a bit before jumping into it.
And now we have the security issue on top of that.
Yeah, no question. But just again, staying with Tyler's point, I think what's holding it back, there's sort of a bid and ask between a vision and discipline. Okay, so clearly M&A activity. I think technology disruption is a catalyst for M&A activity, because there's really two choices. One, you can build it or you can buy it, and the game here is to get to market. From an investment perspective, you've got to see whether you're too early, because there's going to be a shakeout between the winners and the losers, and you want to back the right, back the right investment in that context. So we've seen lots of crazy valuations. I mean, General Motors just bought a artificial intelligence company 4 guys in the garage, no revenue, $1 billion valuation. So you want to make sure that's a good bet. That's a big bet, and so it's a big factor.
Yeah, I think on the M&A front, you have a lot of the bigger companies are smarter now about avoiding being completely disrupted, like some of the last generation of companies may have been. So you see the big technology leaders, Amazon, Google, they're all trying, Microsoft, they're all trying to make sure they're buying in these companies that might be the potential disruptors of them in the future. You know, they make a lot of these companies don't work out, right? So a lot of it is hedging your bets and just making sure. And so the $1 billion for something like that, you have no idea if it pays off or not, but it's protecting, a potential weak spot, basically.
Yeah, no, good case in point. Apple decided they were going to implement the fingerprint technology. They went out and they bought a company called Authentic. Authentic had been on the market for 3 or 4 years. Nobody was interested. Apple made that company a success. Immediately, every other fingerprint company was purchased. There's no fingerprint companies now. We're not going through the next generation of fingerprint companies. So there is a herd mentality. And when you have a big bank account in the industrial sector, they're placing bets that this could be the technology that sticks. And they went out and they bought these companies.
The industrial sector has also seen quite a bit of disruption in perhaps, you think the old line manufacturers, and it's all technology now. It's not just autos. I mean, all these industries have really changed the way they move products, build products, get that product out to the consumer. I mean, some of them, I almost want to say, feel like a technology company.
Yeah, I mean, they were some of the early adopters of robotics and global supply chains and sourcing and things where they were driving down costs as they had to all of a sudden compete with all of these emerging market companies and other countries and other companies around the world. And so they've been, as a matter of survival, having to adopt a lot of technology.
I do think your point, Jim, around sort of backing winners and losers, I think is an important one, because the one thing I think is different, I mean, innovation and sort of disruption has been around for a long time. It's the pace of it has changed, right? We're in an exponential sort of curve around constant innovation and or constant disruption. And so I think what's really hard is, yes, M&A is certainly an answer, to acquire innovation and or acquire new technologies, new markets. But it's how long do you have to return on that before the next best thing comes in? And I think that does make valuation sometimes challenging. And maybe the capturing the now is enough to return on that investment, but you've also got to be horizon scanning for what is going to come behind it. And I think that's one of the biggest challenges, and that's what's different around this innovation cycle. It's just keeping up.
Yeah, you're absolutely correct. Barrier to entry is critical, okay? And barrier to entry comes in a couple of forms, One, it could be market share and market dominance. That's great. It lasts for a while. It could be the IP. It could be your work methods, et cetera. But what we find, the real barrier to entry is the talent pool you're able to attract. Okay. At the end of the day, all this technology is driven by people, and if you build the team that can execute against the strategy using the technology, that is huge. Now, keeping that team motivated, incentivized, and all that's the challenge as well. But that's where you see the Googles and the Amazons and the Intels and Qualcomms of the world who have succeeded in keeping the top talent in-house, delivering, executing day in, day out.
I think the other tricky thing about valuing technology companies is so many of these industries tend towards monopoly, right? And so, and then where you have, and not in the old-fashioned way of buying all your competitors, but just where people get used to using one thing, this path dependence, and then all of a sudden Google's now the monopoly in pay-per-click advertising, and you have to. There's this asymmetric bet you make with any company where if you happen to hit on the one that becomes a monopoly, it's worth tens or hundreds of billions of dollars, and then if you don't, it's worth nothing. And that's the whole. That's where a lot of these, and you go through these cycles where technology investors overestimate the chance of being the winner, and you see that going on right now with a lot of the unicorns.
Right.
So it's just something to be careful about.
And in terms of funding and backing some of those companies at the VC stage, though, what else is there to bet on these days, right? You really want to make sure that you're trying to find the next big thing. I was talking to someone from a VC firm just 2 weeks ago, and it's all technology. I mean, it's really trying to figure out who the next winner is going to be. And there's so many of them. There's so many great ideas, right?
And you see, it's really a lot of the returns are driven by a very small number of venture capital firms that happen to be in those big deals.
Yeah.
We don't play that game ourselves because we it's just not the risk we like to take. We like to focus on sectors where there might be multiple winners. But I think the big payoffs in venture capital are really concentrated in a small number of firms.
So what sector do you like now? What is one of those sectors that looks like it has a lot of potential? I mean, if you found IoT years ago, I'd love to know what you're looking at now.
No, we still look at it because we've been tracking it all along, and we do think there's a lot of opportunity, particularly in vertically oriented solutions. Someone who's trying to solve problems in oil and gas or agriculture or manufacturing, right? And using that technology to make companies more efficient. We've been looking a lot in healthcare IT recently because that's an area that's been slower to change. And then you had some of the catalysts under the Obama's first term with the High Tech Act and the Affordable Care Act that are now creating lots of new opportunities in that sector. And we've been looking at also in education, which is an area that one of the last ones to really get disrupted, very protected industry or service, but there's opportunities there as well. So there's lots of opportunities, and also just applying technology to business services, right? Because now people can outsource a lot of functions. They can you can become more efficient in a people-based business. So we're actually seeing a lot of good opportunities in business services as well.
Let's touch on healthcare, Jim, because this is an area of focus for your company as well. What do you see as a potential there?
Well, it's huge. It's almost limitless in many respects. I think there might have been Times a journal article yesterday talking about the after heart disease, the second largest cause of death is medical error. So whether it's poor record keeping,
that it was depressing.
or wrong medications or lack of accountability or whatever. So that certainly suggests that electronic medical record keeping is key to sharing data, timely data, things of that nature. The other areas are clearly there's a tremendous amount of fraud. We have our cost of medical service is the highest in the world, I believe, and the element of fraud is a big part of that. So using technology, and in our case, using identity management and authentication, where people are, coming into the medical facility, whether the billing's accurate. So there's a lot to take care of fraud aspects in health services.
Nadine, you had mentioned insurance earlier. I would think for the fraud, too, this is another area that really we can see some significant strides in hopefully going forward.
Well, I think there's a lot of insurers out there that would like to underwrite cyber risk or sort of that type of a risk, and it's no doubt that it's a big risk facing our entire economy. But the challenge would be to how do you actually price cyber risk? Because I don't think we know what we know what we know, but we don't know what we don't know. We don't know where that threat is going to be and how significant and large that can be. So I think there's one aspect that's on the business side of it. But then, in financial services, we're dealing with, private sensitive customer information. And so I commend the financial services industry around the steps that they've taken to be, frontline and best in class around fraud and cyber risk protection.
Two of you mentioned education, and that's an interesting one, and perhaps not an area people traditionally think of, but there's so much open learning online courses now. Many of them you don't pay for, but what do you see, Jim, on the education front as disruptive going forward?
Well, I think you're going to see, as you suggest, more online education, a more advanced education going to online because the cost of enrolling in an institution and room and board and all that is extraordinarily expensive. We've got this whole student loan debacle that we're dealing with right now. So I think one of the keys is to understand who the student is with some degree of assurity that it's Rhonda versus Nadine taking the test for Rhonda because she's an expert in economics and you're a language major.
Maybe I'll take the test for her.
Exactly.
Whatever. So again, I get one aspect of technology would be the authentication for the student. So we're working with the computation field to actually use a biometric in the desktop to give you identity with certainty, and that student would be clearly enrolled and earn that degree under her name.
Interesting. Can you invest in that yet, Tyler? Is there an investment play in education?
Yeah, so education's an area you have to be super careful, right? Because it's really hard to sell into that sector, and there are a lot of protected interests. So right now we're actually focusing on the things that aren't that disruptive. Things like supplemental education materials, things like we have a company that helps bring speech pathologists online into schools that can't hire them full time. So there's areas where you're helping make things better. But it's actually a sector I think its big disruption is still a ways away because it's pretty well protected by both the entrenched interest, but also the brand names of universities on the higher ed side. It's fine and dandy if I want to take courses online, but I need a degree from a great school to get a job working in finance in New York, right? And I don't know when that changes. And so I think it still will be a slow sector to be totally disrupted.
Jim, when you go about looking for clients or clients find you, what did you think of in terms of product development? What was the product development thought process that we know we have a product that really can change many industries? So how did you come up with that idea to be a disruptor?
Yeah, it's really important question. Actually, the whole founding concept of the company was to take technology that had been around for 20 years and present it to the public, to the consumer, to the enterprise market in a fashion in which they could react to it in a seamless fashion and be very comfortable with it, okay? Until the iLock development of our video technology, you would find this biometric pretty much in law enforcement and military, where the customer experience or the soldier or enemy combatant experience or the incarceration experience was much more difficult. So clearly we wanted to present a technology that would be readily adaptable to the consumer market.
Nadine, I don't know if you've talked to many people who have been directly impacted by the disruption phase, maybe a decision maker in financial services that said, I think we need to try it. Jim's got a product, let's bring it on. How much second guessing goes on? That you are trying to progress. This might be the right technology, but maybe it's not the disruptive technology I need.
Right. So this really goes, I think, to the question of how do we house innovation in our organization, and how do we allow challenge to happen, and then how do we make sure that we're not discarding things because sort of status quo is easier. And I think that's something that large institutions struggle with, right? So I think it's good corporate business decisioning these days to sort of make sure that you have a challenge function, and that challenge function is protected. And that it allows then sort of disruptive thinking to come into the organization, to create thesis, and to challenge the status quo. And I think that's one of the biggest things that people struggle with. And one, you mentioned attracting talent. So how do you want to make these legacy industries attractive to people who might not have a view that they are attractive because they're slow to move. So we had to work against brand a little bit there. But then once they come in, you want to make sure that they're thinking differently. And so what I've seen is a couple of things. So one is you house innovation labs, and you give them that box that they're allowed to play in, and nobody in the rest of the organization disrupts that. And then they have a channel to go and take that to decision makers pushing business models forward. The other is sort of the rise of corporate venture capital funds. Mm-hmm. And so it's really access to thinking that they don't know yet, that they might need to think about in their organization. So we're seeing a lot of that. So people who are using sort of capital to at least horizon scan and understand who is out there and what might be relevant to their business and or what might threaten their business. And I think that has served corporations well. And then the other thing is we talk a little bit about how do you de-risk. M&A certainly is a phenomenal tool, but we just issued our most recent capital confidence barometer last week, and we talked about buying but bonding, right? So it's about alliances, and I see the rise of alliances and those types of relationships outside of the traditional industry ecosystem being used a little bit to infuse lateral thinking and or different thinking. And I think all of those are tools available, and I think we need to think about what else do we need to do to make sure that we're open to the next.
And then Tyler, how is that done on the risk side? How is those relationships managed? How is the thought process, the innovation lab, the capital that's going into some of these projects managed on the risk side?
Yeah, so we're always having to try to stay ahead of other investors in our sectors. There are sectors that we invest in that are great sectors for us, and then 2 years later, everyone else figures it out, and it's hard to do new deals. And it's nice when that happens, right? Because then, on the exit side, valuations have increased, but you always have to be looking for the next thing. And it's hard, right? I mean, it's just something that you can spend a lot of time, but I think it just has to be part of your DNA as an organization to constantly be willing to look at new things that you maybe haven't done before, and throw up investment ideas that 2 years ago would have seemed crazy, but then you realize, hey, actually, the time has come for something like this, and it just has to be part of how you think. It's funny. We started as a media and telecom fund in April of 2000, which I like to joke is like November 1929 in our sectors. And we just realized that we could either stay a media and telecom fund or we could just ride the waves of disruption, and we decided to do the latter. You just have to make it part of how you operate.
Well, in that sector too, what's a media company? What's a technology company?
Right.
I mean, Facebook now you would consider a media company.
Yeah, they sell advertising. Yeah.
But getting back to risk, I mean, risk is inescapable. So there's risk if you invest, you got too early, you've got the right team, et cetera. Risk if you don't do anything. And then there's the risk that you wake up and your network's been hacked. And all the things that Nadine talked about in terms of the positive, proactive, corporate activities are real important. And then you find out that your database has been exposed to the public and your brand is at risk. And you really need to revisit your basic defense lines for your network and look for cybersecurity mitigants that can minimize that going forward. How
is cybersecurity going to get disrupted?
It's always getting disrupted, right? I mean, because there's always the new thing. First it was the viruses that spread by email. I remember maybe 7 years ago or 6 years ago, we had a series of companies all succumb to DDoS attacks, and then you figure out how to solve that problem, and then there's a new problem, right? And so it's always getting disrupted. And a lot of the companies that are now kind of hot companies weren't around even 5 years ago. So that is a sector that's constantly changing.
Yeah, no, I agree. I think the other thing is sort of the more that we have individual and multiple sources of information, as opposed to, we have to protect against multiple sources of intrusion. And so if you hear things around distributed ledger technology and blockchain, some of that is really intended to get to one version of the truth, and maybe we can protect differently around some of those things. Or we need more database information that is shared. And so I think there's a combination of maybe a risk and cyber risk element to it, but it's also about sort of more information sharing collectively underlying all of these organizations and companies.
On the corporate culture issue, Jim, you raised this earlier. Is there any corporation that's more welcoming of disruption? I'm even thinking geographically in the U.S. compared to, say, Europe, compared to Asia.
Well, I think Silicon Valley has, invented the term disruption, and I think they promote and encourage, and certainly are looking for the talent base that is just lives for, enjoys, and gets that feeling of satisfaction. So clearly, that's one of the greatest strengths that the U.S. economy has, is that innovative, imaginative, creative, disruptive talent base. Other people try to, employ it, adopt it, and bring it into their culture, all with different degrees of success. And it really takes senior leadership to create the pathways internally, some of which Nadine already covered, where this becomes part of your corporate DNA, is that you've got a group, a Lab 126, behind closed doors, Skunk Works, really working on things that are not profitable today, but are futuristic, that are going to pay huge dividends down the road.
Yeah, I mean, I think even within the U.S., you have these certain areas: Silicon Valley, New York, Seattle, Boston, Austin, that embrace new technologies and change, and then you have other parts of the country that are on the receiving end a little bit. But the United States has embraced it. East Asia has embraced it. There are other areas. I think Europe and Japan have been more held it off, and they've kind of held on to the manufacturing economy a little longer. They've adopted the technology, but they aren't on the cutting edge like we are. And then there are other areas that have been totally thrown in, that are totally in chaos, right, with the modern world and technology and globalization, like Middle East, for example. So I think it's a huge geographic disparities in terms of adoption and benefiting or being affected by, disruption.
I think there's a huge opportunity globally. If you look at economies that perhaps aren't necessarily sort of structured with lots of legacy institutions and legacy infrastructure, they're just going to leapfrog. They're going to go right to next version. And so if you look at Africa, where they're bypassing sort of land, and going right to mobile technology. And I think we could be instructed by looking globally around those places where there's a leapfrog effect, because they have the benefit of a blank page. And so as opposed to sort of fixing what we have, they're just building what we need right from the start. And I think that's going to be really interesting to watch. And we talked a little bit about your sort of opportunities globally as well.
Yeah. No, it's leapfrog is the key word, because it's going to take too long to build the infrastructure necessary to deliver. And if you can use mobile technology versus landline, I mean, you're decades ahead.
And why do you need the infrastructure now, right?
Exactly. Yeah.
Where is the pushback coming from in disruption? Is there pushback from corporate boards who perhaps don't want to have the innovation lab down the hall? Is it from shareholders who say, listen, this is nice, but I think the money should be returned to us? Is there pushback that we're seeing now anywhere?
I think no one would admit to it, but yeah. I mean, because anybody who has a tried and true way of making money hates to put that at risk, right? And that's, I guess, the innovator's dilemma, right? And so there's kind of subliminal pushback a lot of times to embracing big change within an organization.
It's also threatening to embrace change.
Yeah, I think about it in terms of inertia. And so if you've got a successful business and you've got a steady stream of revenues, earnings, the growth rates are right, you might just hold back. But again, back to leadership. Most leadership knows that formula is not forever. And but clearly there is pushback or lack of excitement. I'm 3 years from retirement, or this board member has got a different outlook on the economic growth, et cetera. There are pushback points, and it's up to leadership to overcome them, with a vision and to be able to communicate the upside.
I think there's in some cases there's urgency, but I think all organizations are facing that same dilemma about return now and focus on what I can do now versus investing for the long term, right? So that while it's happening faster, certainly exponential sort of innovation cycles, because it's happening so fast, people are saying, I got to really look out there and look at that horizon and see where I need to go. That might be a longer-tailed R&D cycle. That might be a longer-tailed investment cycle. Do I have the ability to do that because I have to meet my sort of short-term revenue and results objectives? And I think that dilemma is no different for corporations. It's just what's driving that discussion, I think, is different.
I actually think shareholders as a whole, right, don't get enough credit for being willing to embrace long-term investment projects. They actually do. And you see a lot of the most highly valued companies are ones that don't guide to quarterly earnings and have a lot of long-term investment projects out there. And so I think it's almost a laziness on management's part to be, I've got to just focus on these quarterly numbers and doing stock buybacks and all that. And I think that shareholders will embrace long-term investments as long as it's articulated clearly.
That's right.
Does the pace of disruption change with the ebbs and flows of the economy? If the economy were to slip, does that mean some disruption moves from the fast track to slower, or is it the exact opposite? The economy is slowing down and we've got to figure out a way to juice things up.
Well, it's both, right? So you have, and it creates, I guess, the creative destruction part. A lot of the destruction happens during downturns, right? So the companies that may have been hanging on, had some, were able to raise some money to stay afloat, they go under during the downturns, right? But as people often point out, a lot of the really exciting companies of today were founded during downturns, where people get creative and start a company, and they actually focus on what they're trying to solve as opposed to trying to get caught up in sort of a VC wave. So, yeah, I mean, I think it's just part of the process. It's part of how capitalism works.
Yeah, I think when you've got exogenous risk out there that's threatening your, sort of your performance, you're actually, in some respects, looking for solutions. And I think that's when you're sort of innovating, perhaps with a different mindset, but you're still innovating.
Jim, as a disruptor and innovator, what has to be your next innovation to remain a disruptor? You don't have to share specifically what it is, but you can give us a general idea.
Well, it's kind of simple. We've based all our success on putting the right team together, hiring the kind of talent that's forward-thinking and stays on top of their field. So that's our challenge, and that's what we continue to do. We try to attract people who are going to take us to the next level and to be ahead of where the competition might be.
When does marketing come into play when you're a disruptor? How quickly do you want to push it out there?
Well, this is a good form of marketing for us. So we like this. Actually, we find a lot of people are coming to us rather than us spending a lot of money on marketing. But clearly, you need to be able to craft the story and the solution so that people can measure it in terms of how it affects their business, their lives, provides a level of security at a affordable economic equation that makes sense. So that's all part of marketing. We've got about 45 employees. Every engineer is a marketer. Every marketer has some sense of technology and engineering. So it's a close-knit group of talent that's able to talk the story but deliver the results.
And marketing happens to be, I think, one of the most disrupted of all the sectors, right? It's constantly changing. What works is constantly changing. And a lot of people can find success when they embrace a new marketing platform. Like people who were early in embracing pay-per-click, right? We're able to get an advantage. And then that market's pretty efficient now. Facebook is another one. And then now you see with the content marketing, people writing content and getting it high on SEO to be able to drive traffic and get leads that way. And now you have real-time bidding in advertising technology where now advertising inventory is traded like a stock, right? And so you're seeing these changes happen so fast and they kind of come and go. Once they become efficient, they kind of lose their allure and people are off to the next thing. Mm-hmm. It's really incredible.
And the efficiencies, I think, in the financial services side have been very interesting just to watch over the last few years, especially, it was just a few years ago that many of the big companies were struggling mightily and serious trouble during the Great Recession. Right. What do you think inspired or prompted it? Was that a kickstart for many of these companies?
Sure, I think an existential crisis is certainly always a little bit of a motivator, but and I think what came after that was regulation, and that sort of carried the tidal wave to some degree. So there's some real fundamentals that needed to be addressed in the industry, and but now and of course if you go into a sort of a struggling sort of time for the industry, and you still have to return to your shareholders, you're looking at, you're looking at operating models, you're looking at costs, you're looking at those types of things. But then you're also thinking about how do I grow my addressable market? How do I create new relevant product and or service experiences, et cetera? So I think it's a combination of all of those things.
Do we see a case where some customers, they don't want disruption? They liked it the way it was, too much for them?
Yeah, I mean, those are the late adopters. Right, where
that's the fancy
term. Yeah, I mean, that's if you go through the bell curve, right, they're the last ones who eventually break in and get a cell phone, right? So there are always those people who complain, but they eventually come around.
Is there anything beyond technology that is a disruption driver? Can it be people?
Yeah, I mean, I think globalization is one. I mean, that's kind of entwined with technology, but that's a huge one, right? Because you basically have huge disparities between the amount of wealth in all these countries that are now connected to each other. And then, through technology, you have, I think, the spread of ideology and things, whether it's Western ideology going around the world, or you have the pushback, that's driving a lot of the terrorism around the world too. And it's all kind of connected to each other, and the technology and globalization are kind of enabling it. But that's disruptive too, right? And causing a lot of change around the world.
I don't want to get political, but climate change obviously is going to be a disruptor if the predictions are true in terms of extended droughts. It's going to leave a lot of people looking for food sources, rising waters, melting ice. That could be fairly disruptive. Mm-hmm. And I'm not sure there's a technology that we have yet that's going to be, the savior in that realm, although technology certainly will help in terms of emissions standards and things of that sort, but that'll be disruptive.
We've talked about a lot of industries, financial services, healthcare, technology, education. Is there an industry we haven't talked about that's worth mentioning as a disruptor? Media, of course, too, we discussed.
Yeah, well, I think in reaction to global warming, there's a lot of interesting things going on the technology side as well. Solar energy being one. It requires subsidy from the government now, but there have been big strides there. That's an area we've been looking at. You have you also have the electric cars and a lot of the automation in the driverless cars and things. That's all a lot of is tied to driving efficiency too. So
I want to move actually to a viewer question here. So let me pull that up. If not all of the unicorns are going to be in the monopoly in their industry, will there be a new wave of M&A to deal with the losers, or will they just die? Tyler, that's one for you.
Yeah, it sounds like it's. So it's funny, advertising technology is one where you can find these market maps online, and there are so many companies that got funded and started there. And and so people talk about a shakeout. Oh, we're going to see all this M&A and these companies are going to get consolidated. No, I mean 80% of them will die when they run out of money because there's a lot of me too, right? There's not a lot of, if you don't have the customers, you don't have the revenue, you don't have really innovative technology that someone else needs, you won't get bought.
First mover advantage, I would assume, if you first and get it right, it's going to be hard to duplicate, for instance, what Jim is doing. I mean,
it's first mover and first executor, right? Because I think there was Friendster before Facebook, but Facebook also figured out the right formula. So but no one's gonna. It's hard to topple Facebook to do just a plain social network. So you have to also execute.
We have another question actually that I just want to get to, and Nadine, we'll pull over to you then. Do you see the trend continuing of VC dollars chasing Silicon Valley startups for exits at 20 times or more? Tyler, that's probably for you too.
Yeah, I mean, I lived through the last one, the dot-com bubble and crash. And so right now, I think there's a lot of talk about the industry just kind of slowing down. And the problem is there's still a lot of money on the sidelines. And unless you get that real big downturn, I think it will continue to stay flowing. But next recession, it's probably over.
Nadine, I know you wanted to make a point.
No, I just wanted to go back. I think your point, Tyler, around execution is really important because all of those advantages that allow startups to sort of start and thrive, sort of that frictionless behavior, sort of the creative behavior, et cetera, as you scale become I think where the challenges sort of come to play, and so I think it's not, you have to be able to execute and you have to be able to scale in order to survive, and I think sometimes that's the tipping point equation that isn't quite there. So I thought your point was very good.
So we have another question I will pull in as well. Do you think that activist investors have the best interest of shareholders in mind in terms of long-term value creation, or are influencing companies in the opposite direction? And I'll just add an addendum to that, and let's do that in the case of disruptors. So are activist investors helping to move disruption along, and is that a positive?
Yeah, so in finance there's always the ability to go to excess, right? But I think the idea behind activist investing is a good one, right? It's like what people say, how private equity or venture capital can, you have somebody, you solve the agency problem where you have shareholders actually standing up for shareholders' interests. Now again, it can be taken too far. You get a lot of Me Too ideas, a lot of kind of gimmicks of looking to just do a buyback and that kind of thing. So it all depends. It depends on the quality of the activist.
Yeah, I mean, one size doesn't fit all on activist investors. Some guys are looking for a quick turn. Some guys have the long-term value in mind, and you really have to understand what's behind their activism and what they have to say, rather than just taking a position to shake up the board.
Yeah, I agree with both of you. If it forces a dialogue that allows you to sort of defend and or improve your business thesis and strategy, then that's good. But I agree with you. Anything taken to excess is going to be harmful.
And it also makes people better managers as they kind of analyze, where am I vulnerable to activism, right? It keeps them on their toes in a way that can be good. As long as, and you can beat back a bad idea. If an activist has an idea that, they have to win over the other shareholders. So I think overall it's actually, a relatively healthy dynamic.
So one thing I wanted to ask all of you before we run out of time, and Jim, I'll start with you. If you could, in your mind, push out 5 years in your industry, what do you think disruption will look like then?
Well, 5 years is a lifetime in our industry.
That's right.
Well, I think we're looking at a degree of ubiquity. I think we're looking at maintaining privacy in a much more secure way than we are today. I think the Internet of Things will actually serve mankind well, although there's lots of risks that need to be evaluated and dealt with. I'm bullish on the future. 5 years is a tough timeline to fully give you a great prediction on, though.
It's okay. It was a pretty good prediction, I thought. Nadine.
So I think the incumbents will be there, but I think there will be new players at the table as well. So it's going to be a slightly different competitive landscape.
So big versus small, does it matter as much?
Yeah, well, it does to some degree, because I think you have to sort of, when you have to look at sort of likelihood of competitive business model and sustainability of competitive business model, and there's a benefit to having large and sort of access to capital. There's a benefit to nimbleness, but I worry that in our financial services sort of ecosystem, there is a portion of the population that might not be survivors.
And Tyler, of any of the industries that you're looking at now, just pick one and project out 5 years for us. Good luck.
Yeah, right. Well, no, so I think the one we've talked about, Internet of Things, but I think tying in robotics, AI, virtual reality, right, is sort of the next platform for the next mobile phones. Right? I don't know if it's 5 years from now, but I think that'll set off a whole new wave of innovation that'll go a generation or more. I think, and that's embedded by all those changes happened in tech. It's built on the changes happened already in technology.
And I'm going to go down the road again. The biggest risk to what you see coming in 5 years, Jim.
I see cyber risk as something I'm really concerned about.
Nadine?
That was going to be mine.
Well, define it actually in the technology space and in financial services. So how is it?
Well, obviously cyber risk is the ability for some bad people to infiltrate networks to their advantage, which is your disadvantage. Some of it's economic driven, but I'm thinking more about critical infrastructure, our electrical grid, the railroad systems, nuclear facilities, et cetera. There's some real points of vulnerability in our networks that interconnect many of these activities, and we have a lot of work to do to strengthen that.
So I was just thinking about this, and I think that in a world that wants more, faster, open, all those things that we've sort of now become accustomed to and wants it globally, I think the biggest risk is that we become national and we put up borders around the ability of transactions to happen frictionlessly across countries. And so it could be global regulation and or sort of sovereign domain protectionism that could threaten sort of some of this disruption.
That's an interesting point. Tyler?
Yeah, I was going to build on that. I mean, I think it's politics. I think there's a lot of change happening, and not everyone benefits from it or don't perceive themselves to benefit from it. And the last time you saw this in the Industrial Revolution, a lot of bad theories came out that thought about how you could reorganize the world, and we've spent 50 years trying to beat that back.
Well, you guys have been just a great panel. It's been a great conversation. So I want to thank all of you for sharing your thoughts. Wide-ranging discussion. It was really terrific. Thanks so much. And formally, I want to let you know that I've been speaking with Jim Demetrius, CEO of iLock, Nadine Merchandani, America's transaction leader in the financial services office at EY, and Tyler Newton, partner at Catalyst Investors. Thank you so much for watching.